Hi, I'm Andrew with Jesani Wealth Management, and as part of our overall investment philosophy, we do use a multi-dimensional asset allocation strategy, and one of those dimensions is our asset allocation, which usually has anywhere between 9 and 12 components, of course, depending on the individual investor situation. But two of those components are typically within the real estate asset class. So those two components can be, one of them is REITs, or real estate investment trusts, which is a real estate fund essentially. It can be publicly traded like a stock, or it can be a private fund. And the second one is real estate syndication, which is really quite a bit different than a real estate fund. And it really has its own benefits and also some significant downsides for an investor that I think are kind of important to explore. So the first question, what is a real estate syndication? And the definition of a syndicate is really a group of people coming together to accomplish the same goal. Of course, in the real estate syndication, this group of people, the syndicate, are seeking a profitable real estate transaction that can generate income, and then they can sell for a profit at the end of the business plan or the market cycle, which should be 3 years, 5 years, 7 years, sometimes even 10 years down the road. The thought is that when you're pooling your money together with other investors, you're able to gain access to opportunities in the real estate market that you would not be able to on your own, either due to lack of resources or just unavailable opportunities. So there's really two main parties within that syndicate. You have active investors and passive investors. So an active investor, which is also known as the sponsor or the general partner of the syndicate, is really responsible for all operations of that transaction and maintenance. So they go out, they identify the property that they want to buy, they put the financials and the proposals together, they put the private placement memorandum or the offering memorandum together, they execute the transaction, they raise the money from the passive investors, and then they continue to monitor and manage that to make sure that it remains a lucrative proposal for the passive investors. And then lastly, an exit strategy on the investment, which is usually a specified time period, either again 5 or 7 years, when they expect to sell that real estate for a profit. And it's important to know that a real estate syndicate can be more than one property. It just so happens that multifamily and apartment complexes are very, very popular right now, but it could be anything. It could be commercial properties, it could be land, it could be self-storage units, it could be even mobile home parks. Now, different than the active investor is the passive investor. So their role is really to just collect their income from the investment and hopefully a capital gain at down the road 5 or 7 years. They have no say in the operations of the syndicate. And really the most important role for any passive investor is to do extreme due diligence on that particular syndicate, their track record, the management's track record. And there's a lot of ways to do that. One can be reading the offering documents. Two is researching their track record. Another one would be to reach out to current investors in that syndicate and get feedback on, how's their reporting, how are their distributions, how's their communication overall. These can all be great ways to do due diligence to see if this is one of the syndications that makes sense to invest in. But also there's a couple kind of core measurements that we like to see for any operational syndicate. The first one is your cash on cash. We like to see that at 8% or above. And cash on cash is simply the cash income that's generated from the initial investment. It's basically the end of the line return on your investment. Also, we like to see an average annualized return of 15% or higher on a real estate syndication, with a risk-adjusted internal rate of return anywhere over 13%. And lastly, there's something called the revision cap rate. What this is it should be higher than the cap rate, and it's looking out, it's a projection of what the end value of that investment will be at maturity or at the exit strategy. Now, there's three phases that the syndicate or the general partners kind of go through when beginning a syndicate. One is the organization of the syndicate. Typically, it's an LLC or a limited partnership. And then is to find the asset that they want to acquire or identify the property that they want to acquire. So that's the organization phase. And then you have the operational phase, which is once that asset has been acquired, you need to report to your passive investors on the profitability of the real estate investment. You need to pay out the distributions. Sometimes there is a third party called a joint venture partner that the general partner will have come in and assist them with some of the communications and just the day-to-day operations of the fund, but not always. Sometimes it's just the general partners that are actually kind of doing the legwork in the operations. And lastly is the liquidation phase, or the sale of the property, or the exit strategy. So when you're trying to determine what is the payout structure for the passive investors, you can certainly find that in the private placement memorandum or the offering documents. But there's really two primary ways, or two key kind of points to know. One is called a split, and it's really quite simple. Whatever the profits are on that given year from that investment, they're distributed on a predetermined percentage basis, partly to the passive investors and partly to the active investors. Usually you see structures that are 70-30, 80-20, once in a while 90-10, and that's 70% to the passive investors, 30% to the general partners. Now, a more common and certainly more attractive structure to a syndicate is what's known, it could be called a waterfall or a preferred share. So the way that works is, let's say a syndicate has $1 million in profits. Well, what they'll do is, and this is all determined upfront in the offering documents, is first the passive shareholders get what's called a preferred share or a preferred dividend, which can be anywhere between 6 and 9%. So let's say it's 8%. So of that $1 million, 8% return goes to the passive shareholders. So let's say that takes up, $800,000, for example. Now you have $200,000 left to be split between the general partners and the passive investors. So usually it'll then go to a split strategy, let's say 70-30, where that $200,000 remaining goes 70% to the passive investors, 30% to the general partners. It can also continue beyond that. So it could have a clause in there where once the passive investors reach a total return of 15%, any profits thereafter go 50-50 to the passive investors and to the general partners. So all the details of the structure and the breakdown of the distribution are, again, in the offering documents, which it's important to note the offering documents or private placement memorandum is very different than a prospectus. So a prospectus is issued by public companies or companies that are issuing shares to the general public, whereas the shares that are offered in a real estate syndication transaction, the SEC qualifies them as non-registered or restricted shares, which means they can be quite illiquid. And I'll talk about this in a little bit more detail when I get into the pros and cons. But if you have restricted shares, you can't just go out and sell them into the public. There is a specific rule, it's called Rule 144, where you can go to a transfer agent, get the legend of those shares removed, and be able to sell them. But the probability is very, very high. That's going to be a long, expensive process, and even higher that you're going to end up selling those shares at a discount to what you paid for them. So that kind of is going to lead into one of the core kind of cons of real estate syndicate investing, and that's the timeline and the liquidity. But also in those offering documents, you can find the investment summary, which is going to give you things like the listing price of the asset being acquired, the current net operating income, the rentable square feet, the average unit size, and all the details about the property that you're acquiring. Also, you should see rent comps in there, so comparable properties within that geographic location and the income that they're able to generate for investors. Also, a demographic market analysis that should also discuss the submarket in that arena. And then finally, the deal structure, which is going to be the cap rate, which is another very important quantifier of a real estate syndicate. And the cap rate is really a ratio of how long it takes to get back all of your original investment. You also see if there's any preferred shares or any splits thereafter, and also any fees aside from the splits that the general partners of the syndicate are collecting to manage the property, of which there are some, which I'll discuss in a moment. So what's the major benefits and negatives of investing in a real estate syndicate? Well, the benefit from a passive investor standpoint would be that you get access to investment grade properties that you couldn't access on your own. And you have access to deal flow without having to actually go out there and find attractive properties on your own. So those are two of the big ones. Also, when compared to like a REIT, you as an investment advisor were able to focus in and kind of target very specific markets for our clients, then diversify among those specific target markets. So what I mean by that is just an example. Let's say that we like data centers in northern Texas. Well, we can go out and find syndicates that are acquiring data centers in northern Texas. Now, we could also go out and find a REIT, a real estate investment trust, that maybe has 30% of their investments in data centers throughout the United States, and the remainder is scattered across, multifamily or industrial properties. So the syndicate allows us to be a little bit more refined in that diversification of your investments based on more macro trends. Another benefit would be the tax benefits to investing in real estate, which I discussed in a previous video. You can assign depreciation to the income that you're getting, so it can be quite a favorable tax treatment. Also, you have the potential for a capital gain at the maturity of the investment, which kind of opens the way for, if you do create a capital gain during the exit strategy, there's then other strategies that you can use for that gain not to be taxable, like the 1031 strategy. And there's actually other syndicates that are structured specifically for 1031, so you can go from syndicate to syndicate. They're also available in retirement accounts. The other attractive part of investing as a passive investor in a real estate syndicate is that your liability is limited to your investment. So let's say John Smith goes out and buys an apartment complex, finances part of it, and the real estate market crumbles. Say we have a scale back in the overall real estate market, and he needs to sell that property or needs liquidity, which alone would be one reason not to have done that transaction. But anyway, he still then needs to pay back that loan. So we're assuming he's leveraged on that property, and he could certainly be on the hook for much more debt than the amount of his original investment. That's one of the core benefits of a real estate syndicate, is that as a passive investor, you're limited to your original investment. Typically, if a scenario like that happened in a syndicate, it's the general partners or the sponsors that are responsible for any debt or liability like that you could incur. And lastly, the last pro is that historically, real estate syndicates have quite an attractive overall return. So when you look at some of the averages out there, the average annualized return is somewhere between 10 and 20%. with a net IRR, risk adjusted, between 10 and 15, and net cash on cash return between 7 and 12%. So when compared to other asset classes, it can be quite an attractive proposition to invest in a real estate syndicate, at least historically. But what are the downsides and the trade-offs to get those benefits? And the main one is certainly liquidity. So when you invest in a real estate syndicate, I discussed how they're unregistered shares and can be quite illiquid. This needs to be assets or investment funds that you don't need at least throughout the business plan of that syndicate, which is usually at least 5 years. 5 years is typically the real estate market cycle. So you want to assume that you won't see that money till 7 years in case something goes wrong. So it's essentially very, very limited or very, very expensive liquidity. And secondly, the minimums on real estate syndicate investments can be relatively high when compared to a real estate fund or a REIT, whether it's traded or public, usually $50,000 to $100,000. And that, combined with the fact that it's very illiquid, can be a turnoff for some investors. There's also other fees aside from the split fees that I talked about earlier. So typically the general partner does get an annual management fee to maintain, report, control that property and make investment decisions on it. That can be anywhere from 1% to 4%, depending on the syndicate. So that can be significant fees, especially when you compare to other asset classes that are available to investors. And lastly, although this could also be seen as a benefit, you really, once you invest in a real estate syndicate, you have no control over the decisions. If you buy a REIT, a publicly traded REIT, or even a private one, and you don't like what the fund is doing, you don't like what they're buying, you don't like the management, you can typically get out of the fund. Or if you buy a publicly traded REIT, you can just go in and sell the stock. You don't have that luxury in a real estate syndicate, which kind of goes back to why it's very, very important to do your due diligence upfront on the management team and the track record of that syndicate. So if you ever have any questions about real estate syndications, we identified quite a few of them. You can certainly reach out to me. My name is Andrew with Jesani Wealth Management, and I can be reached at 954-800-8552. All right, thanks everyone.